Welcome back. This is part 2 of our Chapter 6 discussion for itemized deductions. And where I left off last time was right here at the charitable contribution deduction. And there's going to be a little bit of overlap here with our last in-class lecture, but charitable contributions, it's a pretty important deduction for the vast majority of individuals. And just want to make sure that we really get all the fine points here sort of hammered home before that first exam. So real quickly going through kind of the general slides on charitable contributions. The first thing we have to make sure we do is make a charitable donation to an actual qualified charity. So this means an organization that maybe is already a 501c3, someone like the Red Cross or a hospital, a university, something like that. It is not a political party or a specific candidate. They are not considered qualified charities. So if you make a contribution to some sort of political campaign, that is not considered charitable in the at least the eyes of the Internal Revenue Code. And the last big point kind of from this first slide is that the amount we deduct really depends on what we give up. Cash is always the easiest one to think of, but when we start donating things like our property, the rules can get a little dicey. But first with cash, as we said last time, these are usually pretty straightforward. We just need to know what year we actually paid by cash, check, credit card, whatever. We do not get to take a deduction now if we've only pledged to make this contribution at some other year in the future. So we just follow the cash. When we give that cash up to a qualified charity, we then get to turn around and take that itemized deduction. Aside from normal, just writing a check, giving some cash, we also lump in here costs of transportation and travel for charitable purposes. So if you spend time doing some community service, something like that, should point out community service that is not court mandated. The actual cost you incur just driving to and from that service is potentially deductible as a charitable contribution. You can either add up your actual gas receipts, that sort of cost, or you can just take 14 cents a mile for 2012. The last point here on this slide about value of services. What this means is while we can take some deductions getting to and from providing a service to a charity, we can't then take a deduction for the amount of money we would have earned if we'd gone to work instead of going and helping the community or some other charitable organization. So an easy example here to think about accounting partners. A lot of firms have at least one day of service per year. The partners, everyone get out and they do some sort of big charitable project. Ordinarily, when a partner is at the office doing normal day-to-day accounting work, he or she could bill up to $500, maybe $1,000 for an hour of his or her services. You can't do that when you're just going out and serving the community. So there's no reason that if I give you some facts saying that there's this lawyer or a partner in a firm, what have you, they go out, they spend this amount of time doing charity work, otherwise they would have charged some amount. It doesn't matter what that some amount is, you're not going to be able to deduct it. But if they actually do give some of their own money to a charity, that's deductible. And then also if I just tell you that they drove X number of miles, that part's also deductible, just not their time. All right, so moving on to property. So everything but money. When we're talking about giving property to a charity, the first thing we need to know is what kind of property is it? Meaning, is it capital gain property or is it ordinary property? Capital gain property just means stuff that we buy as basically an investment. It's something that we bought expecting it to appreciate in value later on, and it's not something that we just use every day. It's just not really what we would normally consider our kind of personal everyday possessions. It's a collectible, work of art, or possibly like a rental property or something that we buy. It's not our couch, our clothes, things that you might normally associate with giving to like Goodwill. So when we give capital gain property to a charity, our deduction in general, we're going to get pretty favorable tax treatment. We can take a deduction for the fair market value at the date that we make that donation. So when we're talking about something that we bought expecting it to be really valuable, if it has in fact appreciated in value, that deduction that we get for just giving it away to a qualified charity, it can be pretty sizable. However, the IRS has intervened and lowered that deduction for capital gain property in cases where we give this property to a charity and the charity then uses it for some purpose that is not their normal charitable purpose. The most common example you're going to see there is you give it to a charity and then they turn around and sell it. And assuming that charity isn't in the business of selling things, that means basically just that we're going to have to take a lower deduction. When that lower deduction rule kicks in, it just means that we only get to deduct what our basis is in that property, what we paid for it, rather than what it's worth. So for an example of that, we have our taxpayer Claire. She donated a painting to her church. So her basis in this painting was $2,600, but it was actually worth $10,600 when she donated it to the church. So what the church then does with this painting determines how much Claire gets to take as a charitable contribution deduction. So for these three subpoints down below, the first one, if the church just hangs that painting in the chapel, having a chapel that's decorated with religious themed articles, that's all sort of pursuant to that charitable purpose of the church. So that's perfectly okay. In that case, for this first point here, Claire's deduction is just going to be the fair market value. It's going to be $10,600. This middle point is where we really have to be careful. So the church sells the painting. The church is not an art dealer. So by selling the painting, they're not sort of furthering their tax-exempt charitable purpose. But as long as Claire is truly unaware that the church was going to sell this thing, she can still take the $10,600. It just becomes really hard to prove that you didn't know this in real life. And I would say that a lot of times the IRS, they would maybe err on the side of caution there and say that, well, you assume they weren't going to hold on to this, so we're going to make you take a lower deduction. But with the facts that we're given here, I will say that the deduction is the same. It's $10,600 for these first 2 points, whether they hang it or whether they sell it and Claire didn't know. It's this last one where Claire gave the painting to the church and the church told her that they were going to sell it, that they needed the money rather than the painting. Again, the church is not an art dealer, so by selling this stuff to Claire's knowledge, Claire then is entitled to a deduction only equal to her basis in that painting. So for this third point, instead of $10,600, Claire can only deduct $2,600. All right, so aside from capital gain property, I mentioned that there's this stuff called ordinary income property. So this is usually what people give when we talk about just taking some of your possessions and giving them like to Goodwill or something like that. This is, your old furniture or your clothing, things like that. Not stuff that you bought expecting it to be worth a lot more at some point later in the future. With ordinary income property, our deduction, it's a lesser of test. We get to deduct the lesser of what that property's worth when we gave it away or what our basis is in that property. So, with those three tests in mind, there is a overall limitation on our kind of total charitable contribution deduction. The most we'll ever get to deduct of charitable contributions is half of our AGI. Now, the IRS has intervened and made this limitation a little more complicated when you give capital gain property. So what this slide amounts to here is that while in total we could give cash, ordinary, and capital gain property, like all of that could add together and we could take up to half of our AGI, only 30% of AGI can actually come from this capital gain stuff. So to the extent that we want to give half of our AGI, we're really limited here with this capital gain. So maybe we have some really expensive piece of art, maybe we could make one contribution of capital gain stuff, and that gets us to exactly this 30%. In order to make the maximum charitable contribution deduction, we would then have to give another 20% of our AGI, and it would have to be cash and ordinary income property. So what that means is if I had some work of art that was extremely valuable and it was worth, say, more than 30% of my AGI, say it by itself was worth half, all I would get to deduct attributable to that really expensive work of art is this 30. And then there would just be some piece of it left that I'd have to carry forward to future years. I could still, though, give some extra cash and get back to this 50%. It's just that they won't let you take up to half of your AGI in any one particular year if all you're giving away is this capital gain property. So real quickly, I'll get back to that Excel summary talking about different limitations. So here in this section on charitable contributions, the overall limit, like I said, it is 50% of AGI. It's just that you can't make that whole 50% from capital gain. So the formula that I've put out here is, first we just start with the max we're ever going to be able to deduct, half of our AGI. We cut off from that half of AGI whatever percentage of AGI we decide to contribute in the form of this capital gain stuff. So this part here in brackets is the piece that we need to contribute in cash or ordinary property just to be able to meet our total 50%. So if we want to max out our contributions, this chunk here in brackets is the piece that we have to make in the form of cash or ordinary income property. And then we just tack on the piece of the capital gain that we gave. So if we did give something that happened to be 30% of AGI and it was capital gain property, then what we're left here is that if we want to make our maximum possible charitable contribution deduction, we need to give another 20% of cash and ordinary stuff. If we decide not to give any capital gain property, this part down here at the end goes to 0. So does this. So to make our maximum contribution, what we're left with is we'd have to make 50% of AGI contributions in the form of cash or ordinary property. So it's just this formula, all it really amounts to is that you're not getting too much from this one source that the IRS is kind of wary of, this capital gain stuff. There's always got to be some cash or ordinary property involved if you're going to make this full 50% deduction. And that's what these subpoints here amount to. The total limit is always 50%. It's just that if you're going to hit 50%, you've always got to give up part of that in the form of cash or ordinary property. To that effect, no more than 30% of this big maximum deduction can come from capital gain property. If you donate more property than that in the form of this capital gain stuff, then anything that's left over once you use this 30%, you just have to carry it forward and take it some other year. And then this last point just reiterates what's here in this formula. If you want to make a 50% contribution, you can use cash and ordinary property to sort of plug that difference between half your AGI and whatever you gave from capital gain stuff. All right, so getting back into the slides, we're pretty much done with the charitable contribution piece of it. We'll see a lot of different examples on exams and certainly on the handouts on Blackboard, but those are kind of the high-level rules. We'll start getting into other deductions here in the next installment.